One of the questions, well, two of the questions at the moment that I'm getting almost every day is, where are we in the cycle? And the second is it 2007 all over again? And as I don't have time to go through the first question in a lot of detail, I would like to focus on the second one and touch on a couple of points. If we are looking at the comparison 2007 and today, there are two elements where I would like to focus in on: rents and yields. In 2007, the rental side was a challenging one. The markets were very strong on the economic side, the occupational markets were bustling, and rents were very high. In many markets, particularly in the eastern part of Europe, they were over-rented. If we are currently looking into the rental side of the equation, rents are typically very sustainable, potentially below the levels where they need to be. In the UK, it's a bit further advanced. If we're looking in most parts of continental Europe, it's below the level where you would normally expect them to be. So from a rental point of view, the trends are looking very healthy. If we are looking at yields, the situation is different. I will touch on that a bit later. Yields from a real estate point of view seem to be expensive. If you're looking at it from a slightly outside point of view, if you're a multi-asset investor, yields for real estate seem to be relatively cheap still. So something to look into a bit later on. So the question is then, well, and obviously Richard already showed it, why is everybody still worried? I'm not worried about Trump, but it's one of these events across the globe that is currently having a very big impact on the sentiment that we see in the real estate investment world. It's just one, because there are many. This is information that I'm already using for quite a while, but we're starting to see a drift in the trends. 12 months ago, 18 months ago, this was the picture. What I'm showing here in green, the line, is the real economic growth across the globe. And what we've done, we plotted the big geopolitical events that happened over this 30, 35-year period. And the point that I always said, geopolitics are not going to cause global economic growth to drop below zero. And I still believe that. However, there are many factors that are currently affecting the sentiment of investors. We have China. We have deflation risk linked to interest rate rises in the future. All kinds of gossip out there. Political events. Obviously, Brexit is only one, but there are many. The tension still between Russia and Ukraine. The Middle East, migration issues, closing of borders, politics that are getting more right-wing in Europe. So the combination of all these events is getting very tricky. And as soon as more or multiple of these events will coincide, it is likely that the EU, as it currently stands, is getting or is being put to a test. So that is something to watch. One of these events probably the EU can take. Two, potentially as well. But what happens if multiple events are happening at the same time? Then it might get tricky. And that is what investors at the moment are seeing. I have to say, though, I'm working a lot on a global level as well. And if you do one step back, the events that we are seeing in Europe at the moment, the slowdown of the investment volumes, as I plotted here, so this is Europe, that is something that we're seeing in the US and in Asia Pacific as well. So it's not a European trend that we're seeing. It's very important to watch that. And this is all driven by all the global risks that we're seeing out there. And the two main ones are being slowdown of economic growth in China and the risk that we've reached the peak in the US. However, the slowdown in investment activity in Europe was anticipated. These are results of the investor intention survey that we do on an annual basis now since 2013 and generally present at MIPIM, so in March, April during each year. And if you look at the number of respondents, we had 1,250 global investors asking the question, where would you invest during 2016 in Europe? The responses for the UK went down from around 1/3 willing to invest in the UK to 15% willing to invest in the UK. So the slowdown in activity in the UK shouldn't have come as a surprise based on this information. If we're looking at Germany, let's leave 2013 aside. the responses over time are pretty much stable. So the interest is still there, and we're seeing that in the deal flow as well. It's just taking longer. People are waiting for the right moment in time to do the deal. And this is particularly in Germany, very much product availability driven. So the demand is there, the willingness to invest is there, the product is typically not always there. So that's keeping the volumes under control. Some positive news there as well. If you look at the Netherlands and the CE countries, those are the ones that are really standing out in terms of more positivism, more willingness to invest, and that is where you see the investment activity going up. So if you look at the sentiment survey, so the sentiment that investors had at the start of the year, it's pretty much reflecting what we're currently seeing in the market. And I think if you drill into the reasons behind the slowdowns, looking at the UK, for example, everybody knows that real estate in the UK at the moment is quite expensive. Sellers are quite aggressive in terms of trying to achieve prices that are above the prices that are typical in the market. So as a consequence, some of the deals are suffering. And then all the Brexit turmoil added on top is obviously not helping. So the reasons why this is happening. Just making a small step to the occupational markets, what I've done here, on the vertical axis, the current vacancy for a range of markets. Please don't try to study these. You will get a copy of the presentation. But Brussels is around 10% current vacancy. So vacancy, current vacancy on the left-hand axis. And on the horizontal axis, you will see the development pipeline for this year under construction as a percentage of total stock. Yeah? So that shows how volatile the rental cycle may get over the next 12 months. I will show you a slide later on, running up to 2020. So currently, in terms of development activity, it's pretty slow. There's not that much activity going on across Europe in most of the places, with the exception of Warsaw and some of the other CE markets. So that's good news. Not that much development is typically a reason why rent would go up. But if you would move this to 2020, this is the same scale. There are markets out there that are moving very quickly to the right. And that's based on experience, how quickly the markets are reacting as soon as rental growth is appearing. But also based on actual pipeline that is getting under construction at the moment. And in particular, the markets in Eastern Europe, Warsaw, a relatively big market there, Moscow, this is obviously having a very big impact on rental growth expectations over this time. But also a market like London City, here in the middle, roughly 12–13% of current stock getting under construction to be completed by 2020 is a lot. Dublin, around 20%. So there are markets out there that are moving much faster than others. And this is, as I said, going to have an implication on rental growth expectations for these markets. And without going into too much detail, I tried to summarize the rental growth expectations till 2020 in 3 lines. One, the line for London City, where you saw quite a strong uptick in rental growth already happening in 13 and 14. Expected to top towards 2017, and after that slowly falling again, or at least slowing in terms of rental growth. If we're looking at the Eurozone, so let's say Western Continental Europe, most of the rental growth still needs to come through. So the dotted line is the projection that we made, our outlook. And this is something what I'm spending quite a lot of time in Amsterdam. This is what I'm seeing in Amsterdam as well. On the south axis, rents are slowly but surely creeping up again, but also in locations like Southeast, where major vacancy existed over the last couple of years. People were complaining about those locations. A lot of transformation took place. Vacancy dropped very aggressively, citywide as well in certain locations, and rents are starting to pick up again. So real rents, not only headline rents. And then the third tier is, let's say, Central Europe, where generally a lot of development activity is taking place, which is favoring most of the prospects of rental growth in these locations up to 2020. Having a quick look on the yield side, this is what I said at the start. Real estate is expensive from a historical point of view. I've taken the Amsterdam prime office yield line, that's the top line, so the lime green line, and I tend to compare it to the German government bond. So I didn't take the Dutch government bond, but the German government bond, just to reflect the international character of capital. And the gap between the two, so the lowest line is the 10-year government bond for Germany, the top line is the prime office yield for Amsterdam. The gap between the two shows how interesting it is from an institutional investment point of view to go into real estate. And if you look back over time, since 2002, well, there was one period around 2012 where the gap was a bit bigger, but you can say that historically it's a huge gap. The gap has never really been as big as it currently is. So from that point of view, real estate is still relatively cheap, because there are no real alternatives at the moment to go into with a similar risk-return profile. Let me add that. Having a quick look at the comparison prime office yield in red, and this is the European average, and the secondary office yield. There is a huge spread also between these two. So looking back to the period in 2007 where the lines were much closer, there was around 125 basis points between. Currently we're looking at, what is it, 200, 250, 300 basis points still. And we're seeing the secondary line getting closer to prime. That process is underway, and it's probably going to continue for the next 12 months, if all the things are staying equal. Because we're seeing as well in the investor sentiment survey that we did, that there's a move again from value add, opportunistic back to core, on the back of all the risks that the investors are seeing happening. So people only want to take, let's say, the secondary product, secondary locations where they feel comfortable. So that will typically be in the bigger cities in Western Europe, continental Western Europe. And just to conclude my part, I thought this may be interesting to you. We've been speaking about historically low yields. What we've done is plot the yields in a number of cities over time. The cyclical low, so that's the dark green dot, typically one of the lowest dots on the chart. The current yield, that's in pink, and the cyclical high. Cyclical high is obviously the highest point. And for most of the markets across Europe, the current yields are at or below the previous cyclical low. That indicates that from a real estate point of view, yields at the moment are sharp, are very sharp. There are some markets, however, in Europe, generally in Central and Eastern Europe, where the spread between the pink dot and the dark green dot is still considerable. And these are the markets where most of the cross-border money didn't go to yet. It's only a handful. And the question now is that capital willing to go for that risk premium against the additional risk that you would typically run into these markets? And that is a very interesting point, and I think that's something we may want to discuss during the panel.